Scott Wren of Wells Fargo here. As we wrap up this year, we're looking at a 24% gain or thereabouts on the S&P 500. Sure, it's been a little bit top-heavy, but the rest of the market has started to participate. Is it too much too soon, or can we now trust this as the trend?
Well, Mike, I think there's a couple of problems going on, or a couple of potential problems going on. One is I think the market has some upside here because, let's face it, there's 150 or 170 basis points priced in terms of Fed cuts. We're looking for 2, maybe 3, something like that. And then also the consensus estimate on earnings, in our opinion, is too high. It's about 245. You're hearing some 250 numbers out there. We're at 220. So I think right now inflation is going to continue to come off. I think the market is overestimating how soon the Fed's going to cut and how much. And then I think they're also a little overly excited about the earnings growth for next year.
Now, 245, I mean, it sounds aggressive, whatever. It's about a 10% gain off of what we're going to do in 2023. But if you look at where it's anticipated to come from, a lot of it is just big pharma companies that have massive write-downs this year. They're going to probably not have those next year and gain it back. And then you have communication services, which is Meta and Alphabet, and you have tech, which is Microsoft. So in other words, it's a lot of stuff that doesn't necessarily seem to rely on the macro economy being wonderful.
Yeah, I think those big companies that have good earnings growth, clearly they've had a positive effect not only just on the earnings number, but also on the market as a whole. There has been some broader participation, as you mentioned a little bit. But, for us, if we look out at GDP, and I looked yesterday, and it looks like the consensus for next year's, 1.4, something like that, percent GDP. We're at 0.7. So I think that's part of it as well, as the just economic growth. The underlying economic growth is not going to allow a lot of companies in the S&P 500 to really increase earnings to the magnitude that the street expects. So, as we move into the new year, certainly been a great year this year. Only 3 of 11 sectors have outperformed, and they've outperformed dramatically. We don't think that's going to be the case next year. And if we have a modest single-digit gain, something like that, that wouldn't necessarily be a surprise. But we have a lot of clients calling, asking if next year is going to be like this year. And I think that's probably a pretty low probability event.
Yeah, I mean, clearly you can't pencil in 20+% every year and many years in a row. Although if you're anticipating for GDP 0.7%, you're basically saying the economy is going to go towards stall speed. Presumably, that would mean that the Fed has room to be more active. So is that not going to be a support?
Well, I think here's the thing. If you look at the Fed's 2 mandates, and that's basically low unemployment, which, let's face it, anything really below 5% historically is pretty low. And so we think the unemployment rate might tick up a little bit here. But then also inflation, and inflation's moving in the right direction. So I think it's correct to think that the Fed's going to ease a little bit. But if their 2 mandates are really in line, is the Fed really going to care that much if GDP is 0.7 or 1%? That just helps them keep inflation in check, or is at least part of keeping inflation in check. So we don't think that the Fed's going to, in a slow growth environment where their 2 mandates are, checked off, that's going to give them a lot of enthusiasm about cutting rates, 150 or 175 basis points.
Yeah, no doubt they wouldn't relish the need to do that very soon. Scott, appreciate it. Have a great New Year. Scott Wren of Wells Fargo.